Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Today we're joined by Lucas Porbeau from Lonsec. He's an investment guru that works at Lonsec, looking after all things about the market, an economist. So we've got a few questions to run through with Lucas about what's happening in the world, the share markets, and investment portfolios across the board. So thanks for joining us today, Lucas. I suppose I want to get an understanding from you about where we are in the markets. It's been a fairly interesting year, might be one way to describe it, with a fair bit of volatility, interest rate movements, etc. Talk of a second GFC. From your perspective, where do you see the markets and where are they headed?
Yes, absolutely. And thank you for having me. And in terms of the markets, it has been, as no doubt your clients would know, pretty volatile. And the main topic really over the last sort of 6 to 9 months has been inflation. So that has been the main thing that has changed from, let's say, 12 to 24 months ago. You know, if we roll back 12 months ago and beyond, you know, the challenge was, how do we get inflation? You know, central banks were trying to stimulate inflation. We had record low interest rates. We had ample liquidity in markets in terms of central banks supporting markets with liquidity. Now that has quickly turned around, and we've seen inflation rear its head, and that's been the culmination of a couple of things. First, we had COVID. We had supply chains effectively breaking down, so the ability for businesses to move goods and services around the world, I mean, effectively that all broke down as we know. So that pushed the prices up for everything. Coupled with that, then we had a conflict, and we do have a conflict, obviously, in Ukraine. And Ukraine is actually a key supplier of agricultural products into the market. Interesting stat, I think, off the top of my head, is about 20% of the world's calories actually come from Ukraine and Russia. So that has put pressure on commodities, including agricultural products, but also things like oil. And then obviously there's been a lot of just stimulus over the years in terms of supporting the economy as well. So there's been a culmination of a whole bunch of things which has effectively put inflation up. And the reason markets have been volatile is, if you think about it, most asset prices are priced off a risk-free rate, you know, be that the cash rate or 10-year bond yield, 10-year bonds. And as you see interest rates go up, the settings in terms of things like 10-year bonds, that changes up. So we've seen bond yields go up from effectively, you know, zero to -0 in some instances, but we've seen that go up quite aggressively. So if you look at bond yields today, for 10 years in the US, you're sort of around close to the 4% mark. Aussie is similar. So that dynamic has really changed. So how assets are trying to price that in is really why we've had that volatility. So markets don't like uncertainty, and what the market is trying to grapple with at the moment is to say, well, how far will inflation go, and how far will interest rates go up? And that's why you're seeing this month to month at the moment. Like, you know, 1 month it's like inflation's peaked. We'll probably sort of maybe start seeing change in central bank policy through to, you know, following month inflation's back, you know, it hasn't subsided, and so on and so forth. So that has really been the primary thing that's been, you know, influencing markets over recent times, and certainly been one of the big things we've been thinking about from an investment perspective in terms of what it means for asset classes, for valuation. So are asset classes looking expensive or cheap, and all of those sort of things.
Yeah, okay. So what you're kind of saying there is that, I'm trying to figure out best, like, say Woolworths might be valued at 15 times excellent as a risk-free return rate, but risk-free return rate's gone up by 2 or 3%, even though Woolworths might be making the same profit, the same earnings, that kind of stuff, the valuation method has changed and it values less because the risk-free rate's adjusted. The actual quality of Woolworths and sometimes the profits or the revenue margins haven't changed, but the way that it's valued has changed because of what's happening in the broader market.
Yeah, that's right. In sort of conceptually, that's right. And there's some asset classes and some companies that are going to be much more sensitive to movements in bond yields and interest rates. And so asset classes like property, for example, bonds, and then to your point, there are specific companies. Certainly, we've seen a lot of more of the what we would call the growth companies. So if you think about, some of the tech companies, for example, you've seen them reprice back because they are more sensitive to those movements in bond yields and interest rates. So that is why we are seeing more volatility. Interestingly, from a bottom-up perspective in terms of companies themselves, if we sort of look at the last reporting season, it was okay. But there are challenges, we think, going forward. And, speaking to some of our analysts, one of the interesting things is being able to find people, basically, to work. And that has been a consistent theme across industry, irrespective of, the type of business you're operating. That remains an issue. So costs are going up as well, employment costs, all of that is still real. And we're probably yet to see, if you think about the interest rate cycle in Australia, with the RBA has been notching up rates, but the impact of that, to see the impact of that, it probably takes about 12 months, The consumer, if you think about the consumer, over COVID savings levels went up. So people are, in this sort of period, there's still, you can eat into your savings and you can sort of eat into, say, credit card debt or whatever it is. But at some point, if we see, cost of living go up, you will see demand, we think, gradually sort of plateau out, which is what the RBA wants. But when we're yet to see that, and even with mortgage rates, a lot of people have fixed rates. As those roll off and you reset to those higher rates, that's going to have an interesting impact as well on things as well. So I think all in all, look, the next sort of, I think what it all means is that if you think about the market, let's say, a year ago and beyond, it was, in a way, it was a much more easy environment because you had record low interest rates, you had central banks effectively supporting growth assets in many respects. So the decision just to invest in equities, go long equities, was a fairly easy one, and everything went up. Whereas I think where we're heading into is a market of potentially on an aggregate level, lower absolute returns, more volatility, but I'd argue more maybe normal levels of volatility. But at the same time, a lot more dispersion between performance between sectors, but also performance between individual companies. So it's not going to be just what it maybe was over the last 3 years where you just throw your money into any equity and it all goes up. There's going to be a lot more dispersion, which does mean while there'll be losers, there'll be definitely winners. And we think there'll be a lot of opportunity as well because in an environment where everything's going up, that's sometimes challenging as well because, you got quality companies that go up, but then you got poor quality companies that go up as well. It's companies with high levels of debt, companies with questionable earnings profiles. Whereas I think the environment going forward will be much more of, the good will continue to be good, but some of those poorer companies will get will be left behind. So what it means in terms of, being able to sort of really analyze, understand, and get an appreciation of, and which are the companies that you think are going to do well in the future, and which are the ones that are going to be left behind. That's going to be much more important maybe than it has been in the past. So with volatility comes opportunity, and I think that is real. And then some assets that historically have again been trading at really high prices. Some of them are starting to pull back a bit at the moment, so that's also creating pockets of opportunity. So it's a two-way streak in terms of volatility, but that's sort of overall what we're sort of seeing at the moment in terms of markets.
Good. I think a good little reminder in there for everyone, even ourselves and the clients we work with, that let's say the share market returns 0% over a 12-month period. That doesn't mean everyone's portfolio and every single stock's done 0% return. The certain indices will have done well, certain stocks will have done well, and with the right investment philosophy, the right investment management, someone's portfolio can still make 5 or 6% in that year because they're investing in the sectors that have made 5 or 6%, when others might be minus 5 or 10%. So I think often people might see the headline share market down 3%, but that doesn't mean necessarily their portfolio is down 3%. And it sounds like that's going to be more evident in the next 12 months.
I think that's right. I think there's going to be, just a lot of dispersion between the winners and the losers.